Well, let's stay on the markets here on this 1-year anniversary of the pandemic market low, March 23rd, 2020. That is the day that we hit the low, and we've been pretty much off to the races since then. Joining us now to discuss is Andrew Slimmon. He is Managing Director and Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, great to talk with you. Once again, let's kind of start by going back and thinking about the setup on March 23rd of last year. I know you remember it well. It was that Monday morning. Seemed like every Sunday night we were, cascading through the futures into a, limit down situation. What was the setup at that point that the market was kind of responding to, and have you been surprised by the resilience of this rally since then?
Well, I think I was sitting under my desk at the time, so that's what I remember. It was a pretty miserable time, but I think what's important to consider is the market actually, while the magnitude of the rally up 75% off the low was greater than anyone expected, I think it's important to always consider that when the Fed turns accommodative, when they start pumping money, equities do well. And that's the first lesson. The second lesson is the market's a forward predictor. So it will always rally before it's apparent that the economy of the world has turned the corner. And that's what makes it so hard in the middle of recessions or bad situations, is why in the heck is the market going up when things are so bad out there? And now we're at a point where it's pretty apparent that things are getting better. I mean, it's not a straight line, but things are getting better. And that worries me a little bit more, because the market's going to say, okay, well, now we've priced in a reopening, now what? So I think while the magnitude of the rally was greater than anyone thought, I don't see the trajectory of the market as all that unusual.
Well, Andrew, can the now what component of what you just brought up, can it be a 10% pullback, a correction of some sorts? Because I'm not too sure about you, but I've awoken the past 3 days very early, and I've been awoken to fears of lockdowns in Europe, fears of protracted lockdowns as COVID case spike again. Do you think it's time to raise cash because the market is not pricing in things like that?
Well, I think, it's a great question. I think it's a question of your time frame. First of all, you have to remember expectations for the economy last year were terrible off the low. And so the economy was able to beat earnings. Companies were able to beat estimates because estimates were too low. But you know what? Now we're at a point where there's high expectations. We're reopening. Those estimates have come up. So any types of re-lockdown worries, that actually has more of a negative impact because people aren't expecting it. So I think you're absolutely right. There's more risk here. And I think if you look at history, when you have big 12-month rallies like we've had, it would be very normal to have a period of consolidation that could last 3 to 6 months. Now, having said that, the second year of a bull market, and I think this is the second year of a bull market, is a good one for equities. It just comes with more volatility. The hardest part about that first year is people unfortunately raise cash into the low. It happened. It always happens. And then you don't get much of a pullback, an opportunity to reinvest, and the market goes straight up. The second year of a bull market is a good one, and I think it will happen again, but it will be with more volatility and more pain. Look at yesterday. It was, on the surface, it looked like a good day, but not a lot of stocks participated. So that's a more painful day for people. So expect a period of consolidation, expect more volatility, but I still think it's going to end up a good year for equity.
And of course, which equities is always an important question, Andrew. You wrote in your March outlook that value still had more room to run. Of course, presumably you wrote that going into March, and we're several weeks in now. And I come back to a question that Brian Sozzi actually asked at the beginning of our show today, which was, when is value no longer value? When does it get pricey because everybody has been piling in? How close are we to that point?
We're not close yet. And the way I know that is if I take the Russell 1000 and I just look at the 100 cheapest stocks, so priced based on kind of standard valuation metrics, and I look at how cheap they are versus the market versus history, what you see is always in recessions, they get very, very cheap. And then they reprice back to kind of their normal, cheapness. And this go round, they got very cheap last year, and they're about halfway back. And so we've had a nice value rally, but to say it's going to run out of steam here would not be consistent with history. And when I look at those 100 cheapest stocks, roughly half of them are financials. So I think that the value rally is due for a pause. It's had a very good period here. Growth stocks haven't done well. Rates might slow down here, and if rates pull back a little bit, growth stocks will do well. But I don't think the value rally is over, because that's not consistent with history. And I think a lot of people want rates to stop going up because they're heavily invested in growth stocks. But listen to what Chairman Powell is saying. What I find fascinating is investors taper and when are the Fed's going to change policy. But what Powell is saying is, I am not doing anything until the unemployment rate improves. And I'm focused on U6, which is a broader level of participation. And that's still double digits unemployment. So until we get lower levels of unemployment by more, a broader group, I think the Fed is on the sidelines. And that means the economy is going to run hot. And I think in that environment, cyclical stocks. So there's only one thing you have to focus on as it pertains to the Fed is, when is the unemployment rate going to get down low? Because that is the metric they're using. Focus on that. And I think in that environment, value stocks will continue to reprice. And I'm just basing it on history. That's what's worked in the past, and I think it will continue to work this go round.
All right. Value guys, fear not. Your moment is still here. Andrew Slimmon, Senior Portfolio Manager with Morgan Stanley Investment Management. And Andrew, always appreciate the time. Thanks for jumping on this morning. I know we'll talk soon.
Great to see you guys again. Take care.